In this video, I will explain how to predict the evolution of any financial instrument due to seasonality. First of all, what is seasonality? Seasonal fluctuations occur in a historical series on a regular basis. Nature provides the best example of seasonality: air temperature. If we take the average temperature of New York City, for example, we see that in July we have a figure of 25 degrees. This does not mean that every day of every year in July the temperature is 25 degrees, but that 25 degrees is the average of hundreds of measurements recorded over the years during the month of July. If we look at the graph in its entirety, we see that there is a recurrent cycle of temperature, which rises in the summer and falls in the winter. This is the seasonality. Similar cycles also occur in financial markets. If, instead of temperature, we are averaging the trends of any financial market year by year, we will be able to see whether there is a recurrent trend at any given time of year. We are on the S&P 500 page of Forecaster Biz, the software that allows you to calculate the seasonality on all the financial instruments of the world. Just as with temperature, we see that if we calculate seasonality, then the average of the individual trading days over the last 5 years, we see that, indeed, at certain times of the year, there are clear trends. The same trends for the S&P 500 remain even if we calculate the seasonality at 7 years, as we are doing here. We see that although we've added 2 years to our calculations, we still find the same trends. And the same thing happens if you add, for example, seasonality at 10. We see that although we added 5 years to the first seasonality we calculated, the trends remain the same at the same times of the year. Just as it is very difficult to guess a sunny day with high temperatures in the middle of winter, the same is true for financial markets. Why go upward at a time when historically that market, that currency, that commodity has gone down? There are 1,000 ways to trade and invest with seasonality. For example, using seasonality in synergy with technical analysis is a great way to increase its effectiveness. Let's take an example. Does the seasonality of the S&P 500 include a period of recovery? If prices are on a very important support at that time, the chances of a reversal are very high. What we do with seasonality is put the odds on our side, which is the secret to success with online trading and investment. If you like this video, subscribe to the channel and activate the bell so you will be notified each time a new video is published. I also invite you to try out the Forecaster software with which you can calculate the seasonality of all the financial instruments in the world. Visit the site. Without putting your credit card details, you can try the free version of the software.